Welcome to the supplement, everybody, from the 10th of September 2023. This is the real Adam Lawrence rather than the AI version of Aussie Adam. So, I'd like to ask everybody first up to please subscribe to the channel if they haven't already, as it helps the channel out an awful lot. Thank you. I always start with a quote, and this week's is, "The central bank needs to be able to make policy without short-term political concerns." That's from Ben Bernanke, the former chair of the US Federal Reserve. So, a heavier quote this week than last week to go with a heavier supplement. This week I was at the Bank of England quarterly breakfast briefing, which I always attend, and that's been moved back to only being quarterly as things feel a shade calmer all around. It was every meeting for a while in the recent rate hiking cycle. Things feel calmer anyway, and volatility has temporarily retreated. Before we crack on with my analysis of that meeting though, I want to do the macro roundup, because there's a few unmissable bits this week. Retail sales far better than forecasted, but still well below inflation. The PMI indices revised upwards, but still below 50, so things in the economy are still seen to be moving in the wrong direction. And the most notable of them all, the Halifax House Price Index, giving everyone in negotiation for a deal at the moment an absolute gift, reporting a 1.9% drop for the month of August, which is usually a down month, of course. The forecasters expected minus 0.3%, so this really was a significant surprise, and it put their year-on-year figure, which had been much more contained than Nationwide's figure, down to 4.6% down year-on-year. One more figure of interest was released this week. The average rate that mortgage drop-offs go on to from the big lenders. The standard variable rate average across the big banks, if you will. That was reported at a chunky 7.85%. If you consider that buy-to-let is likely to have a premium over and above that, then just think quite how serious that is. There's blood on the streets if you want to make decisions based on the quietest summer for years. Personally, I'd say that's a little knee-jerk, but it could be a gift for negotiation. Anyway, what I missed in the silly season was an opportunity to post-mortem the August Bank of England monetary policy report, and it really is well worth doing for a number of reasons. As so often, it is not just what it says, and what the West Midlands rep has expounded to the group, that meets with regularity to pick his brains and let him make sense of all the noise, but what it doesn't say and what that might mean. Also, I gained a unique insight afterwards into exactly what the bank does and doesn't understand about the current state of the buy-to-let market. The big question will be, how much do they care? But Mark Carney certainly seemed to, and I would like to think that the Monetary Policy Committee will be interested in the feedback that I gave. The spoiler alert is that the bank is now at a place where I was heading with absolute certainty somewhere between 2 and 2.5 years ago and 9 months ago. And some of the facts since then have changed. As the saying goes, when the facts change, I change my mind, sir. What do you do? The report was written for August, and we must remember that at the time, the market forecast for base rate was to reach just over 6% and to maintain an average of 5.5% over the 3-year forecast period. I thought it was worth shouting about that because I did not shout about it at the time, mostly because I was taking it easy on holiday somewhere, not monitoring the forward curve every day. Of all the metrics I do look at, I don't worry too much about the forward curve, which is the market prediction of the future interest rates, because it's not been overly accurate, although it has done a better job of prediction than the Bank of England has done in recent times. In the May report, the average over that period was just over 4%. So that's some difference, 1.5% or 150 basis points. Call the lifeboats. Actually, don't. Things have calmed significantly since then. When you look at today's number compared to those used in the report, peak base is down to more like 5.75%, and the average looks more like 5% or so over the 3 years, but still 5%. So if you're toughing it out on base rate tracker mortgages, base plus 2, let's say, you are looking at 7% interest on average for the next 3 years, or so the market currently thinks. Now, the temptation is to believe that just because the market has finally caught up with reality, that they will continue to be wrong and things will come down a little more than that. I'm inclined to believe that, depending on how future shocks and how Russia and Ukraine continues to play out. With oil creeping back over $90 per barrel this week, then unless the dollar weakens further against sterling, those prices at the pumps are going to stay back over £1.50 a litre, and that filters back through into all expenditure, including food and transport, just as it appeared things were easing on that front. The general prognosis, however, would be stronger for longer. The drum I've been banging ever since the window of opportunity that was afforded to us last year to fix our debt was closed, or at least narrowed significantly. These rates are normal, people are saying. Not so sure about that. In recent history, even if you ignore the past 15 years, they still look at the high end of the range, and the market has now got itself obsessed with the soft landing. This is still an unlikely outcome, and significant economic slowdown could change things. Those who've listened before, when I've visited the briefings, will know that I'm always likely to have a question or two. My above the line, in front of the room question this month was around why everyone, including the Monetary Policy Committee it seems to be forgetting that central bank decisions take 6 to 24 months to filter through into the real world and the economy. Here's the case that I made. The past two unemployment prints have been from 3.8% to 4 to 4.2. The manufacturing PMI is through the floor at low 40s, and the services PMI has now gone sub 50, the big driver of our economy. Isn't it time to pause and see what effects continue here and measure the trend? Now, I didn't say that because of my own skin in the game on base rate. To be honest, brutal though it sounds, I'd probably rather 6% plus and take my chances in the sell-off that would have to follow, but because I really truly believe that is the right thing to do right now. The bank's rep in the West Midlands is an excellent economist. He didn't answer in the way that I would have done, which definitely doesn't make him wrong. What I would have said is that that's all well and good, but services inflation is running near 8% and wage inflation was 8.2 at the last print, and we need to see some evidence that that is calming down before we pause. I would have recounted with the fact that vacancies are still falling backwards, and that trend is really established now, and we'll only have to wait a couple more days for the August figures to come out, which I expect will see vacancies fall back below 1 million for the first time in several years. This is a leading indicator, whereas wage inflation is just the lag effect of where CPI was 6 to 12 months ago, rather than where it is today. What he did say, actually, was worrying to me and caused me to challenge it. He said that it seems that these days the decisions are being made in the now more than they used to be. Remember, don't shoot the messenger, he's only the mouthpiece. But if that is his impression of the current Monetary Policy Committee, that's the best example so far of the weak leadership that Bailey has espoused as the governor, and also a sad indictment of the fact of his lack of understanding of what good central banking should look like. It's no accident that I chose a Bernanke quote today, because Bernanke is leading a review into why the Bank of England has been so poor at forecasting. On to the next concern. The bank, in spite of the high interest rate forecasted by the markets in August, now thinks that unemployment will stay under 5% in coming years. For the first time in many years, I actually think they might be undercooking it, because on my numbers the forecasts look there for a more significant swathe of job cutting, cost cutting and job replacement. The recipe doesn't seem to add up right now. There's still one massive factor that has been hard to measure but factors in here. The true cost of the cost of living crisis. The quote marks have to be out there because everything's a crisis these days. What's evident in the figures is that there has been a soft landing of sorts for consumers in these inflationary times. They had a lot of savings built up during the pandemic, often built up without that being voluntary. Although these excess savings are all pretty much now gone in the US, but in the UK we seem to be doing better with more savings than since the referendum period right up until COVID, where savings did spike massively. We're still well ahead of the 2016 to 2019 savings rate. There's no doubt that we had a big cushion thanks to COVID, but the cushion has at least deflated somewhat. I've talked before about the massive wealth transfer during COVID, all that stimulus. In spite of some of the more ideological spew around all of this, the transfer really massively favoured the middle classes, rather than just the 0.1%. There was a near trillion put on the household balance sheets, while we all focused on government debt. Nearly 150 billion found its way into ISAs during the period. I can't imagine too many of the 0.1% bother with their ISA allowances, being honest. The cost was, and is, inflation, and these savings are still providing that cushion mentioned above. Remember, the US is a fair way ahead of us in the UK. The FCA have some solid data, and in fact the best proxy might be the Big 9 balances, deposits held by the 9 largest institutions in the UK. That only moved from £1.24 trillion to £1.233 trillion between January 22 and May 23. A mere snip of a £7 billion difference. Nothing, some might say. Well, perhaps. RPI, remember that, the retail price index, over the same time period tells us there was a 16% fall in the purchasing power of money in real terms. Take a breath, but for those who are feeling the pinch on certain prices and items, holidays for example would be a good topical example right now, just imagine the amount of real wealth that has been destroyed, equivalent not to the 7 billion nominal dissaving in that time, but instead 205 billion in real terms. 205 billion. This is the price of the transfer from government to household in 2020 and early 2021. Hope you made the most of those bounce back loans. Still, back to the bank. Their recent proclamations will interest you, I'm sure. Q2 2025 is now the time at which the bank thinks we will return to the 2% inflation target. This is in line with what I was saying way back when. These cycles do tend to be around the 36 to 48 month mark when you look historically, and as soon as the genie was out of the bottle, we knew wages and prices would be sticky, because they always are. I was stunned to see the bank suggest that they had learned this in the recent cycle. History could easily have taught them that this would be the case. That's all I had at my disposal after all, and the appetite to do the work, of course. They also now see CPI at between 4 and 5% at the end of this year. That looks much more likely, although let's just reserve judgment based on the oil price. And it's time to bang the drum for the warm winter again. Just remember how lucky we were last year. The climate forecast system, let's not hang our hat on it, but I'd suggest it is likely better than the Daily Express model, doesn't see a single day below freezing into late February 2024, which would be a godsend for everyone's gas bill, of course, and ease the pressure on UK commodity prices anyway, although we will remain price takers on oil for the rest of time, or at least until we can stop our reliance on it. If we can get lucky in the winter weather, and warm often means storm when it comes to rainfall, remember, so make sure to check those roofs and gutters, then their 4 to 5% number by the end of this year looks about fair, without a significant event occurring. A real one, not just the next media crisis. Gas prices should stay more manageable, and less heating oil will also be needed in Europe in general. Then again, you'd hope from here that with 4 months to go, they could predict the end of the year's number. It is infinitely easier than 12 months out, when they were suggesting we could be back under 3% by New Year's Eve. Their language is much more definite. Inflation is going down rapidly. That fall has started, and of course these big rises are getting more than 12 months old now, so it doesn't mean things are getting cheaper, just that they've stopped going up at the same meteoric rate for now. The bank admits services price inflation has caught them by surprise. My surprise is that they are surprised. Why did they think it wouldn't happen? There's never been a better time to put prices up, and companies are chasing wage increases as well, of course. The long-term forecast around 2025 now sees inflation at around 1.5%, rather than below zero, which is where they are saying it will be in more recent reports. One point where we strongly agree, however, is investment. This is not traditional investment, this is the investment number for companies in the UK being invested into hardware, software, plant and machinery. A small limp upwards this year, which is a massive fall in real terms, then a nominal fall in 2024, and then we will be cracking on with even more creaking buildings. Very topical with the RAC situation at the moment. And creaking systems as well into the new government. The private sector has had almost everything thrown about it and at it to get it to try and invest. But of course, with cost pressures where they are, companies have to sweat assets very hard in order to survive. The prevailing forecast is growth at 0.25% per year until 2026 or beyond, roughly, before going back to 1.5% plus. This sounds limp, but at the moment, in real time, might be hopeful for 2024. Let's see the next month or two's PMI figures before we make a real call, though. The key for the committee is how persistent these wage and second order effects are, as they call them. Expectations do seem to be coming down, rightly so, and that will help. At the buzzer, though, there's one more nugget from this week to throw into the mixer. My offline question. I always talk to the rep not in front of the room. One, because he may share something he wouldn't say out loud, although he is very straightforward. And two, because it might not be particularly relevant to the rest of the room. Firstly, I spoke with him about a portfolio deal that I can't make stack up at the current rates. The conclusion is, if I was sitting on significant cash reserves, I could do it, but I'd have to accept a nice discount, but then quite a few years before I got any meaningful cash flow. I always stack my deals at 100% finance, as I've said before, and that's protected me in general from getting into any bad ones. Secondly, I told him of all the portfolios I've seen of late floating around. Low rents, poor asset management, floating rate mortgages, banks wanting money back. The biggest time bomb of all for the big personal name landlords is Section 24, being assessed at 45% tax but only getting the 20% credit. Cash flow is hard or impossible for many of those who are still relatively highly geared at this time, in spite of massive rent increases across the board. I doubt many are monitoring their real-time tax positions, but they will be absolutely horrible given the amount of cash flow problems that are being caused by mortgage rates. 25% of cost for the big guns of a mortgage bill, that has moved from 2.1%, I'm assuming base plus 2 here, to 7.25% in the past 2 years. And simply put, that means on £1 million worth of debt, you'd have paid 21,000 and you'd have been able to offset 9,300 of tax against your return. I'm assuming you're being assessed at the 45% level here. So you wouldn't have offset 11,660, and instead that would have been taxed as profit, which would have cost you £5,250. That's moved all the way to £72,500 of payments, with only £32,222 of that fully deductible, and that would have cost you £18,125 instead. So not only are you £51,500 worse off in cash flow because of the interest rate rise, but you're another 12,875% worse off because of on the tax bill side of things. So the total cost of that is 6.44% of the debt extra. Ouch, I think you'll agree is the most appropriate word. And that's not the only fruit either. In times like these, people tend to have the cash flow fight and worry about HMRC later. That's the classic route to receivership and bankruptcy. £64,375 worse off per million of debt than you were between April 2020 and November 2021. Not a small consideration. This only bites when the 23-24 return is filed on January the 31st, 2025 and triggers a big fat tax bill. The largest single incidence of Section 24 in one day. Mark my words. Having said that, back to the average base rate of 5% plus over the next 3 years, the stronger for longer philosophy means that the 24-25 tax year would be even worse. The ones with competent accountants will either already be aware of this or will be told this when they file their 22-23 returns. Significant disposals could be on the way. That always takes me down the same old rabbit hole. You know me well enough by now to know that I want, crave and need the data. I don't want to speculate. The dearth of buy-to-let data is a bit criminal and leads to bad decisions at the top level within the sector. That much I know. The best data, and that isn't hard, is really with the FCA. A few nuggets that I uncovered in my search that finish this point and this week's efforts. In Q1 2023, the share of mortgage advances that was for buy-to-let purposes was 9.8%. That's the lowest observed since 2011 Q4, a market, of course, that was still reeling from the financial crisis and had very few lenders at the table. And that speaks as to why there is just so little rental stock out there at the moment, of course. Balances at the end of Q1 2023 were down. So this is the outstanding balance for all mortgage debt, residential mortgages of any kind. And that's the first time, quarter on quarter, that balances have gone downwards since Q2 2017. So what happened? People used savings to pay down balances overall, or they did not remortgage as they otherwise might have done because of higher rates. Remember, the vast majority of this activity would have been at rates agreed in Q4 2022, which was a horrible time to agree a mortgage. To put that 9.8% figure into more historical context, the data since Q1 2007, which is the start of the data series of the FCA, almost like they knew something was going on, shows an average of 11.83% of mortgage advances being used for buy-to-let purposes. And the 10-year average, which of course leaves out the financial crash and its implications largely, is actually 13.54%. So 9.8 is more than 35% below that 10-year average. There are a whole swathe of numbers of where mortgages are at in the buy-to-let sector, but the prevailing number in the most recent figures is around 2 million encumbered buy-to-lets of around 4.6 million buy-to-lets that exist. That's limited company plus personal name. So it is around 44% with a mortgage, 56% unencumbered. That might surprise many, but it is quoted in a number of sources, including government-backed ones, and it seems to be the best number we've got. Hamptons International has a whole number of other stats, of which they do not quote the source, which makes me worry about their veracity. Nonetheless, they are a large organisation and do produce their own indices. They claim 59% of buy-to-lets this year have been purchased without a mortgage, as investors try to make sums add up, which is interesting to say the least. So it would seem that in at least 50% of cases, those that are ideologically opposed to the landlord do actually have a point. They are sitting on cash and the interest rate does not really affect them. So be it. There is no real decent analysis knocking around over just how much maintenance costs have crushed margins though, before we start on insurance, particularly on flats. We just had one renewal which was up over 300% year on year, and this was a flat where the council is the freeholder. 300%. A stats overload today, but an enjoyable journey as I continue to hunt for the best sources in the game. Some more fruits to draw from that in the future. That once again draws us to a close, and you know what that means. Be sure to tune into the 9 AM live on YouTube if you can, or watch it on repeat. If you don't already know about it, just search up Proponomics on YouTube, and of course, keep calm and carry on.